Hello number-curious friends, welcome to the channel where we talk accounting and finance. Today we continue with loans and borrowings and will cover classification, covenants, KPIs, common mistakes, and we'll take a look at real-life examples from annual reports. Also, I have some news. From now on, I will be regularly publishing accounting quizzes on the channel's Patreon. Check them out. The link is in the description. So, classification. In the previous lesson we mentioned that the loans with the term of less than 12 months are short-term or current. The loans which are granted for more than 12 months are long-term or non-current, and they are respectively recorded as current and non-current liabilities on the balance sheet. But what do we do with the following situation? Imagine we have received a $5,000 loan for 5 years with an annual repayment of $1,000. In this case, we need to show the loan on the balance sheet, splitting it into two parts. The $1,000 which is due for payment in year 1 will go into current liabilities. The remaining $4,000 will be recorded in the non-current liabilities. After 1 year, when the first $1,000 is repaid, the next $1,000 moves to current liabilities and we have $3,000 remaining in non-current liabilities, and we repeat it every year until the loan is repaid. Also, if interest is paid monthly or annually, it will be added to the balances of the current portion of the loan. Now, let's have a look at covenants. When companies borrow money, lenders don't just give cash and hope for the best. They set covenants, rules the company must follow during the life of the loan. These covenants protect the lender by making sure the company stays financially healthy. If the company breaks a covenant, the lender may charge penalties, increase interest, or even demand early repayment. And before we move to the examples of typical covenants, if you find our videos useful, please take a moment to hit a like button, subscribe to our channel or leave a comment. That's very important for the channel. And thanks you for being with us, this means a lot. The most common covenants are based on financial ratios. For example, a company may be required to keep debt to EBITDA or debt to equity ratios below a certain level, or maintain interest coverage above a minimum threshold. There can also be restrictions on paying dividends, taking on more debt, or requirements to keep a minimum level of cash in the bank. The covenants are calculated by the companies and then regularly submitted to the lenders to confirm compliance. Sometimes, lenders may even require that an independent auditor checks the calculation of those covenants. Now to the KPIs. When analyzing loans and borrowings, there are a few key indicators you should look at. First one is debt to EBITDA, which is calculated as debt divided by EBITDA. EBITDA is defined as earnings before interest, taxes, depreciation and amortization. It shows how many years of operating earnings it would take to repay the debt. Why EBITDA is important here? Because it excludes non-cash effects from depreciation and amortization. Interest is also the result of the current debt, and tax expenses are normally considered non-operating and are also often significantly different to actual cash payments. Second KPI is net debt, which is total borrowings minus cash, a more realistic picture of obligations. Net debt is often extended to include other liabilities which are of financing nature. For example, pension liabilities, factoring, finance leasing, supplier financing, security deposits from customers and so on. These liabilities are often called debt-like items. Of course, if debt-like items exist, there can also be cash-like items. For example, loans to employees, government subsidies to be received, security deposits, etc. Net debt is a very important topic for valuation of the businesses, and we will later have a few separate videos for it. A third typical KPI is interest coverage. It tells you how easily the company can pay interest from its profits. It is calculated as EBIT or EBITDA divided by interest expense. EBIT means earnings before interest and taxes. And finally, debt to equity, which shows how much of the business is financed by debt versus shareholders. It is calculated as total liabilities divided by total equity, and is often called gearing ratio or leverage. These ratios are not just numbers, they tell a story. Higher debt usually means higher financial risk. Always compare these metrics over time and against similar companies. That's how you understand whether the company is becoming stronger or riskier. Stable or improving ratios are a good sign. But, for example, if interest coverage is falling, it may signal troubles ahead. Now, let's have a look at how debt is reflected in real financial statements. Let's start with Unilever. Unilever reports in accordance with IFRS and shows loans and borrowings as part of financial liabilities. These are split into current and non-current. Current financial liabilities were 7 billion euros as of December 2024 and non-current 25 billion. They have a note 15C. Let's check it. In the note 15C, we see the split of financial liabilities, both current and non-current. So, as of December 2024, Unilever's debt consisted of bank loans and overdrafts of 521 million, bonds and other loans of 28.6 billion, lease liabilities of 1.5 billion, and other items of 1.4 billion. Further, the note shows the changes in loans and borrowings over the year. We can see that the increase in the balances mainly related to the net new loans received in cash of 1.1 billion. However, we can also see that significant part came from the foreign exchange effects. They were responsible for more than 700 million of the increase. What was driving that? The note also shows us the split of bonds, and we see that some notes are denominated in British pounds. There are also a lot of notes in US dollar. If euro depreciates against these currencies, and it did in 2024 against both, the amount of liability in euro increases. Unilever spreads its borrowings across many maturities. Some bonds may mature in 2 years, others in 5, 15 years or even 30 years. This is called debt laddering. It reduces refinancing risk because not all debt needs to be repaid at once. The cost of borrowings, interest, is shown in income statement in finance costs. For example, interest on bonds and other loans was 959 million in 2024. In the accounting policies, it is stated that interest is calculated based on the effective interest method. We discussed this method in detail in the previous video. Link is in the upper right corner. In the cash flow, loans and borrowings are shown in the financing activities. Here, we see that Unilever repaid 4.3 billion of financial liabilities, but overcompensated that by taking new ones of 5.4 billion, including 643 million of short-term borrowings. Also, they paid 1.1 billion of interest in 2024. Now, a quick look at the KPIs related to the loans. Unilever reports net debt. On page 45, the company defines it as the excess of total financial liabilities, excluding trade payables and other liabilities, over cash, cash equivalents, and other financial assets, excluding trade and other receivables, and non-current financial asset derivatives that relate to financial liabilities. Here, Unilever also shows the structure. As of December 2024, Unilever's net debt was 24.5 billion. Unilever also explains the development in net debt and mentions net debt to EBITDA ratio as a KPI, which is used to assess a leverage level. In 2024, it was 1.9 and decreased from 2.1 in 2023. Now, let's move to PepsiCo. PepsiCo reports under US GAAP. In the 2024 annual report, PepsiCo had around $37 billion of long-term debt and 7.1 billion of short-term debt, bringing total debt to roughly $44 billion. In note 8 on page 98, there is a split of debt. As in Unilever, the majority of debt is notes, and some of these are with the term until 2060. Here, you will also see an example of how the current portion of long-term debt is reflected. 4 billion of loans are moved from long-term debt to short-term debt. Again, as in Unilever, footnote B states that the interest rates presented reflect weighted average effective interest rates. During 2024, PepsiCo issued about $4 billion of new long-term debt and repaid nearly 3.9 billion of existing borrowings, which is shown in the cash flow from financing activities. On page 99, there is a split of issued notes with the maturity and interest rates. In addition, on this page, PepsiCo provides further information on debt. For example, that they have entered into a revolving credit agreement with an ability to borrow up to $5 billion. This is very typical for large corporations. They continuously refinance older debt with new issuances. As part of the KPIs related to debt, PepsiCo shows ROIC, Return on Invested Capital. It looks like this and includes 45 billion of average debt in 2024. You might ask, why not finance everything with own equity? There are several reasons. First, debt is usually cheaper than equity because lenders take less risk. Second, interest payments are often tax deductible, which reduces the cost of borrowings. Third, moderate leverage can increase returns to shareholders. But of course, too much debt increases financial risk. When reading an annual report, here are 4 quick checks for borrowings. Total debt. How big is it compared to revenue and profit? Maturity schedule. When must be the debt repaid? Interest expense. How expensive is the borrowing? Debt ratios. Are they stable over time? These 4 questions give you a better picture of a company's financial risk. There are a few common mistakes in loan accounting. One is expensing loan fees immediately, instead of spreading them over time using the effective interest method. Fix that by amortizing via the effective rate over time. Another one is ignoring the effective interest method altogether and just using the cash interest. Apply the effective interest method consistently. Companies also sometimes misclassify loans between current and non-current, especially when covenants are breached. Review covenants regularly to make sure classification is correct. Forgetting forex remeasurement on foreign loans. Remeasure and reconcile every month. Loan modifications are often overlooked. Document all loan terms clearly, including interest rates, fees, and repayment schedules. Finally, mixing lease liabilities with borrowings. Keep them separate. Here we go. Let's summarize it. Borrowings start with cash in and a liability out. Companies typically use debt for several purposes: financing acquisitions, investing in fixed assets and supply chains, funding working capital. Large companies often issue bonds instead of loans. Bond markets allow to borrow large amounts at relatively low interest rates for longer periods. Use the effective interest method to spread total cost. Capitalize interest on qualifying assets while you build. Classify by maturity and disclose terms clearly. And that's your crash course in loans and borrowings. I will post a few links in the description, which you can check out for annual reports. Next time, we will talk about net working capital. If you have other questions, post them in the comments below. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next video. See you soon and keep those debits equal to your credits.